Hey everybody, thanks for tuning in today to another video here on Selling Vega. It's another exciting day as we continue our options trading series. Talk about the option Greeks, what each one is, how they affect option prices, and how you can use them in your trading strategies. Please don't forget to like and subscribe to our page and hit that alert button so you know firsthand when new videos drop in our options trading series. Now, without further ado, let's get started. Alright, so let's get right into the option Greeks here. I'm sure that you guys have been on Robinhood or your broker of choice and have seen these Greek numbers and wondered what they are exactly. Most brokers will now calculate the Greeks for you, so all we need to discuss today is what they mean and how you guys can use them to your advantage in your trading strategies. The most important Greek is delta, which measures how sensitive an option's price is to a $1 change in the asset you're working with. For example, the delta here of 0.49 means that a $1 move in Apple stock to the upside will cause a roughly 49-cent or $49 move in the option price that you're looking at. So here the current option price is $4.38. A $1 move in Apple will mean that this option's price will go up to roughly $4.88, holding all other Greeks constant. So delta is essentially a sensitivity measure of the option relative to the stock. The higher the delta, the more sensitive an option's price will be to a movement in the stock. The highest and lowest a delta can go is 1 and -1. Calls have deltas ranging from 0 to 1, showing the positive relationship it has with the stock price, and puts have deltas ranging from 0 to -1, showing the negative relationship it has with stock prices. The more in the money your option's strike price gets, the closer the delta will be to 1 or -1. For puts, that's for strike prices above the current strike. So you can see here, the higher we get, the more that delta will approach -1 on the put side. And for the opposite for calls, the more in the money, which means strike prices below the current price, the more in the money you get on calls, the closer that delta will approach 1. Lastly, option deltas are typically around 0.5 for at-the-money contracts. You can see the 155 on both the call side and the put side have deltas right around that 0.5 number, and that is pretty standard. Our next Greek, gamma, measures the rate of change in an option's delta per $1 change in the price of the stock. So a gamma here of 0.03 means that a $1 move in the strike price, in the stock price, will change the delta of this option contract by 0.034. Gamma is both the largest and most sensitive for at-the-money contracts. That basically means that you can expect to see the largest changes in delta for at-the-money contracts. Gamma is another useful tool, especially when using options as a hedge against an already large stock position. A lot of hedge funds, large investors typically like to hedge their large share ownership in companies, and normally they do that via the options market rather than actually selling any shares. They can just buy X amount of puts in order to protect X amount of shares, and they use the delta of these option contracts in order to determine how much shares or how many shares they can actually protect. This is where situations like a gamma squeeze can take place, a concept that I'll be covering in a future video. For today, we're just going to stick with the basics here. Our next Greek is theta, which measures the change in an option price for a one-day decrease in its time to expiration. Theta is essentially time decay, measuring the daily drop in price as you approach that expiration date. In this example, a theta of -0.06 means that all other variables staying the same, this option will be $6 lower in price tomorrow just based on the passing of time. Theta is more sensitive as you approach expiration, and the curve is not a linear one. The theta curve, which you can see here, shows that the majority of time decay will occur inside of 30 days, and it will become more and more rapid as you approach that 30-day window, as you can see on that curve. All right, let's talk about the next Greek here, Vega. Vega is the volatility component, and it measures the rate of change in an option's price per 1% change in the implied volatility of the stock. While Vega isn't technically a Greek letter, it's intended to tell you how much an option can move when the volatility of the stock changes. A drop in Vega will cause both calls and puts to lose value, while an increase in Vega will cause both calls and puts to gain value. Robinhood also calculates the implied volatility, and Vega represents the options change in that implied volatility number. Vega is a very important factor as it can cause you to overpay for options when volatility is high, or allow you to spot opportunities where a higher than normal volatility creates moments where selling options may be advantageous. A good asset to add to your watch list is the VIX. Let's see if I can show you that here. The VIX, VIX. This is a good asset to add to your watch list as it is a measure of volatility. What the VIX actually measures is the implied volatility on a 1-month S&P index option for an at-the-money contract. So it's a good way to keep track of broad market implied volatility, so that way you can know the environment, how volatile the environment is in which you are trading in. The final Greek is called Rho. Rho measures the expected change in an option's price per 1% change in the risk-free rate, aka US Treasury bills. In this day and age of zero interest rates or near zero interest rates, Rho changes are incredibly small and have become almost a non-factor in today's options price, but they are still there and still good to know what they mean and how they can affect you. But given the lack of volatility in US interest rates, they haven't been much of a factor of late. All right, so let's talk now about how I use Greeks in my trading. Let's start with delta and gamma, as they can really be used in unison. Understanding delta can help you be more accurate with your trading. For swing trades or day trades, where I'm looking for a small price movement on a stock in a short period of time, I'll often go for option contracts that have higher, more sensitive deltas, such as at the money or even slightly in the money contracts. I know from my knowledge of gamma that I'm getting an option contract with the most sensitive delta on the entire options chain, so a quick move in the stock price will turn into immediate gains on the option contract. For example, if I think Apple is going to go $2 higher today, I wouldn't want to play a large out-of-the-money call option that has a low delta, like this one right here, because this delta is telling me that I need more than a $2 move to get significant option price movement. And that's why if I think Apple is going to go $2 higher today, I would want to play something with a higher delta, something maybe even in the money, so that way I get more dollar for dollar gains in the option contract on the immediate Apple stock price move. For my income strategies that I run, like covered calls or the wheel strategy where I'm mostly selling options, I like to keep my delta a little lower in these instances. This allows me to get a buffer zone of insensitivity where the underlying stock price can move without my option price getting massively affected by it. Another area where delta and gamma can help is with risk management. By using option Greeks like delta and gamma, you can project what an option's price will be over the coming days based on hypothetical stock price movement. This can help you predict the point at which you would take gains or losses depending on your overall strategy, and can help you with those entry and exit points. Theta, the time decay measurement, is useful in understanding what maturity dates are best to operate on depending on your strategy and what you think is going to happen with the stock price. So let's pull up that Theta chart, or the time decay chart again. So remember, most of your Theta decay is going to happen inside of 30 days, which means that if you're buying options inside of 30 days, you're working with a headwind on your option price going higher, because every single passing day you're going to have some Theta reductions in the option price. So this tells me that the only times I really want to be an option buyer inside of 30 days are, one, if I'm only holding it for a very short period, so it's either a day trade or a swing trade, or I think there's a big volatility mismatch between my expectations and what's already implied into the option price. Even then, it's sometimes still more advantageous to sell an option via a spread rather than just outright buy a single option. And I'll be covering option spread trading in a future video as well, so that way you can get some exposure to those strategies. Most of the options I'm buying are on trades that I'm holding for 2 to 6 weeks. And so I want to buy them as far out on this Theta curve as possible. So I'm usually buying them with anywhere from 4 to 12 months to expiration, to prevent any significant time decay from eating away at my option price. This will take away that headwind and allow me to capture gains when the stock price moves in my favor. In my income strategies where I'm a seller, now I want time decay to work for me. So I like to keep those contracts short, inside of 60 days, since this rapid time decay will be working in my favor. Finally, Vega is useful in my trading in knowing how the volatility environment is affecting the option prices and whether I should be a seller or buyer in that market. For example, if implied volatility is significantly higher than normal, or what is average, it's a better environment to be selling options or spreads, while a lower than normal implied volatility is more conducive to option buyers. And you can find that at the individual level by pulling up any option chain for an individual stock, and it will show you that implied volatility, as well as doing it on index funds such as the S&P 500. You can do the same thing. It will show you what that implied volatility is at any point. And using that watch list to keep track of the VIX is another way to understand what type of volatility environment you're in, so that way you know whether option prices are expensive or more expensive than normal or not. That's how Vega is useful. It provides you that backdrop of knowing what environment you're working in. Option Greeks are the fundamentals that drive the prices of options. Understanding these Greeks will provide you that basic understanding of what's driving prices and allows you to use them to your advantage depending on your trading strategy. I'll be covering more detailed examples of spread trading and delta trading in future videos, so please drop a comment with any feedback, questions, or ideas that you want to see from my future videos. Thanks for watching. Don't forget to like and subscribe to our page, as it really, really does help me continue to help you guys. Happy trading. Let's make some money.